Hello, it's Jeffrey Cohen, Chicago Quantum, President, Investment Advisor Representative for U.S. Advanced Computing Infrastructures Incorporated in Highland Park, Illinois. Our U.S. stock market models are risk off today. In fact, they've been risk off all week, and today the model just shouted out risk off. We updated our website, we told any clients that had purchased runs, and I decided that you all need to know too. And so, what does it mean to be risk off? How did we come up with the hypothesis? Where's the data? How did you come up with it? And then what does it mean? That's what we're going to talk about in this video. So, the first thing that risk off means, right, is it means if you're going to pick stocks, what's the advantage, right? Like of picking stocks, individual stocks, versus just buying the stock market. So here's the answer. The answer is the best stock in the stock market on a risk-adjusted basis is to buy the S&P 500 index. The second best is to buy a short-term bond fund. And then if you run out of that, you can buy some Russell 2000 stock index, and then the QQQ, or the NASDAQ 100 stock index. So the best places to put your money in the short term are highly diversified, no risk. Now there's a low risk public utility out of New Mexico, PNM. There's Carl Icahn Enterprises, which pays a tremendously attractive dividend. Berkshire Hathaway and Ametek, who we don't know. But Berkshire Hathaway, you guys know, that's Warren Buffett's company. So what the model is saying effectively is if you want an edge today, you buy the whole market and you diversify, or you put your money where Carl Icahn or Warren Buffett's mouth is, or you hide out in New Mexico. So this is very risk off. I'm going to tell you what else it looks like when you're risk off. Let's see if I could find this. So this is the actual model run. So if you were to be our client and had bought a run yesterday, you would have gotten this run well before market open, probably last night. And you got your same stocks that are doing better than the S&P 500, and you got high risk, low risk, negative beta, high beta, low beta, stock splits, high volume, low volume, all kinds of data, right? And then what you wouldn't necessarily know is that we ran the model extra long yesterday to come up with 34 stocks. So the idea is that if you were to want an edge, want a risk-adjusted edge in the market, you have to buy 34 stocks, hold them evenly. And one of those stocks is actually the SHY, which is a bond fund. So 33 stocks in a bond fund. So it's stocks like AppV, European Wax Center, right? American Financial Group, Activision, Broadcom. But there's some small kind of weird stocks in there. Oh, Rocket Companies, Rocket Mortgage, Microsoft, McDonald's, Loco, the place that sells the chicken, the Pollo Loco, that's in there. Texas Instruments, Johnson & Johnson, Carl Icahn's company. I think that's... So it's a very interesting, PACCAR, it's a very interesting set of stocks, right? It's highly diversified. Everything from chicken to McDonald's to Texas Instruments to Microsoft to trucks to video games to chips to financial services to pharma. To pharma, in fact. So it's really hard to imagine you're going to make a ton of money buying 34 stocks evenly, 3% each, shorting the S&P 500, and then making the arbitrage difference. It's a tiny, tiny benefit. When we look at the number, It is 9.5 times 10 to the negative fifth. That is a really small edge. So, in fact, it's so small that it's less than our minimum edge. So, all right, that's what risk-off looks like. Risk-off looks like no edge to picking stocks. If you're going to pick stocks, you end up with Warren Buffett or Carl Icahn. And it's just awful, right? And so, how did we get here? So that's the second part of the video. Jeffrey, how did we get here? Right? What does it mean to be risk-off, and how do you get risk-off? So let me talk about it. So it's not a variance issue. The variance of the S&P 500 is the same. It's 2.3 times 10 to the negative 4. It's been flat for a long time now. It's not the variance of all the stocks. The stock variance of 2,747 stocks. By the way, we're going to be adding back foreign stocks that are U.S. listed into this run, and that's going to slightly elevate the variance. But apples to apples, that 3.5 is not elevated. I mean, it's elevated, but it's not any higher than it was a month or two ago. We're plateaued. So what it is that the market, the expected return of the market is coming down. So we have had losses in the S&P 500, the Russell 2000, and the NASDAQ for well over a year. This market has been dropping and falling. And normally I'm like, hey, buy the dip, buy low, sell high, let's go crazy, let's put all our money in the stock market. But I'm not feeling that. You know what I'm feeling right now? I'm looking at CoiFin. By the way, I love the folks at CoiFin. And you look at 2020 when the pandemic hit, yeah, the market really recovered. But then it flattened out and it really peaked around December of 2021. And in all of 2022 it fell. And a lot of you, like us, so we lost money last year. We lost 3% of our wealth last year. That's a lot. Normally, the money goes up. I should have put all $10,000 I had into an I-Series savings bond. I'd have made like 9%. But unfortunately, my $10,000 is spread all over the place, and we lost 3%. That's terrible. Now we're into 2023. We're up slightly. But, when you look at this chart, it doesn't tell me that we're going back up again. And when I look at things like an increase in the corporate alternative minimum tax or corporate tax rates, which could raise $200 to $300 billion a year taken from the corporations, that's probably going to reduce valuations. So let's say it's $200 billion a year. It's going to reduce valuations by $2 trillion 10 times. 10 times annual cash flow, which is not even that high. And so $2 trillion is roughly 10% of the stock market. So you got stocks with a tremendous headwind. Plus you have a president who's picking winners and losers. You have an economy that's wavering. I've got inflation data to show you that there were revisions to inflation, and inflation's been higher by 1.28% or 1.27% for the past year, and they didn't tell us, other than some stupid little technical note on the Department of Labor's website, which, you could be a little more transparent, please. So we have higher inflation, high interest rates, a weak economy, a president that doesn't seem to be pro-business, new taxes on corporations. So net, we think the S&P 500 will end higher this year than it did last year, but not by much. It'll be around 5 to 10% higher. So I think in our model, we're assuming a certain amount, and I'm going to tell you what that is. So the floor rate, or the rate that we think the stock market will go up, is 7.57%. And the way that's made up is it's 6% in capital appreciation. So if the S&P 500 is trading at 4,084, if I take 4,084 and I multiply that by 1.06, I get 43.29. So what we're assuming is that the stock market, the S&P 500, will be trading at 43.29 a year from now. We're also assuming that it will pay 1.57% dividend yield. Now that's a higher dividend yield than it even paid this year, slightly. But I think stocks are not great. You know, companies are going to pay some dividends. I think it's a safe bet. I think they paid like 1.55 in the past year. I can tell you that number. The S&P 500 ETF dividend yield was 1.57. So yeah, so we just assume the same dividend as last year. So, okay, Jeffrey, you have a 6% capital appreciation and a 1.57% dividend yield. I get that. I understand the logic. You don't see the market going up. You see it pretty flat, maybe going up a little. Got it. But that's not enough. So let's talk about the risk-free return is 4.625% or 4.625%. That doesn't seem that high, actually. Jeff, you just told me that I can buy an I-Series savings bond and earn like 6-7%. Yeah, but that's only on 10 grand for a U.S. citizen a year. A lot of you out there listening have more than $10,000 to invest. And so let's take a look at what a risk-free rate of return looks like if you're, in the chips, right? Let's see what I have for you. And I'm sorry, I am not trying to show you any stocks that I might own. This is not a pump and dump situation. I am just trying to find the data that I took aside for you. Here it is. So 1-month treasury bills are yielding 4.57%. So you could right now go to the treasurydirect.gov, buy the next auction, and probably get 4.6%. So 1 month, so that means you're not even tying your money up. It's 1 month. If you want to tie your money up for a year, you get 4.932%. You get almost 5% on your money. That's why we're using 4.625. It's kind of a difference between 4.6 and 5. But there's some other. Let's see if I can find that. Come on now. There it is. 13-week treasury is 4.633. So we're actually below the 13-week treasury. I actually went out to treasurydirect.gov to see what you could have bought recently. So if you would have put your money away for 3 months, said to the Treasury, 3 months, and you would have done this on the 9th, yesterday. No, it's like 4 days ago. You would have done this Monday. You'd earn 4.7%. I love 4.7%. I got to tell you, my wife and I are trying to figure out what we're doing for Valentine's Day. All I want to do is sit with her in front of a roaring fire and talk about how we could have earned 4.7% on 13-week money. And I got to tell you, it's better than that. The last auction, which actually issues on Valentine's Day, is paying 4.7% on 8-week money. You could tie up your money for 2 months at a time and earn 4.7%. So our model is conservative when we have 4.625. We might even need to raise that to 4.7. So what happens is your expected market return is only 3%. So the expected return to risk, putting your money at risk, buying stocks, right? It's crazy. 3%. Why would you do it? Now, to be honest with you, a lot of us have to have our money in stocks. We can't afford to sit there all day and look at the stock market and try to figure out what bond to hold. You go to work. You live your life. You just, you know what? Here, Vanguard, take my money, put it in an S&P 500 fund, and let's walk away a winner. You're not looking every day, but you're only earning an extra 3% for all that risk. Now, risk is elevated. Risk is at a plateau. Risk is higher, 50% higher than it was a year and a half ago. And you're doing that for 3%. This is the return over and above risk-free money. That's not a lot. And God help us if inflation goes up and they raise interest rates another 3%. That means there's no advantage to holding risk assets. You just do it out of a fond memory for when stocks used to go up. That is how we determine that the market is risk off. So hold lots of stocks, be very diversified, take no extra risk because it's only a 3% return to risk assets in the market. Okay. So what does it mean for you as an investor? So let me tell you, because I'm going to keep it simple. If you are a retail investor, so if you don't have a lot of money to invest, you're just like a regular person, right? You work a job. It reminds me of Myron. Myron and I met for lunch one day while he was going for his job interview at the T-Mobile store. Now, I like Myron. He's a good guy. He's a young man. He doesn't have a family. He's got $25,000 in the bank. He's working hard, right? He is a U.S. citizen, so here's what I told him. And honestly, this is not a bad option for most of us out there. For the first 10 grand, go to treasury.gov or treasurydirect.gov and buy some I-Series savings bonds directly from the Treasury. I think right now they're yielding like 7%. So you're going to earn 7%. It's great. Take it. Take it and run with it. It's the easiest 7% you ever earned. Now, what about the rest of the money? I would take some of that money and I would just buy a low-cost passive index equity mutual fund. So, Jeff, what does that mean? I would buy something that has a name like the S&P 500 or the Russell 2000 or the NASDAQ 100. I would just buy something that doesn't cost a lot of money. It doesn't have any load or sales charges. And it just puts money in a large number of stocks. There's a thing called the Wilshire 5000. It's another one of those. And so they're all over the place. Passive, right? So what happens is, for now, while the market is rough, you're still in. I mean, we might be wrong. This is only an expected return. But you're not taking a lot of extra risk. And I dump all your meme stocks and stonks and risky points of view, and I would stick with it. Now, if you really want to own some stocks, what our model is suggesting is go low risk. Buy Pepsi or Coke or Illinois Tool Works or Johnson & Johnson, makes the baby powder. Mondelez, which makes food. Honeywell, which makes industrialized equipment and energy equipment, a lot like Siemens out of Germany. You could buy McDonald's. These are names you recognize. You would go with Berkshire Hathaway or Icon Enterprises, right? And they pay a dividend, and it's great because you're getting some dividend, and you're just kind of waiting it out, right? You could possibly pick up a little gold in your portfolio with AAAU, a Goldman Sachs physical gold ETF, and that's pretty safe. Now, if you want to, hang out with us and get a little crazy, I'll tell you what you do. You buy 34 stocks and you hold them evenly. And every day you say, Jeffrey, run me the model again. And you maintain a portfolio. Sometimes this portfolio is as small as like 7 or 8 stocks. Right now it's 34 stocks. And you short the S&P 500, so it's a hedged, separately managed account. You're long these 34 stocks. Some of the names McDonald's, Microsoft, PACCAR, you do, PNM Energy out of New Mexico, There's Carl Icahn, but then there's Earwax or European Wax Center. You get the hair removed. Well, we actually have one of those by a grocery store near our house. I thought this was a fake company, right? But really, you go and they wax your whole body. Honestly, it feels very painful, and I'm not doing it. I'm a pretty hairy guy. Can you imagine? No, thank you. AppV, Rocket Mortgage. There's some good names in there. Texas Instruments, Broadcom, Activision, APAM, Asset Management. You get some cool stocks in here. And so every day you kind of adjust. You're in and you're out. You're selling, you're buying. A lot of times you end up, because you have to keep these even. If a stock goes up, you sell some. If a stock goes down, you buy some. And so you're constantly mean reverting on these stocks and dollar cost averaging. At the same time, you figure out the beta of these stocks, which we give you, and you have a short position on the S&P 500, so you're not really holding any market risk. That's it. So for any normal retail investors, you can go to chicagoquantum.com/retail, and you can see the conversation we have with Myron. I feel really good about it. Now, we don't make any money if you do this, but you're about as risk-free as you can, and 10 years from now, you'll be thanking me. Hey, Jeff, I dropped some money into an S&P 500 fund. I put some money into some savings bonds, and you know what? I'm going to retire comfortably. Yeah. Because every month or every 3 months, you're going to put a little more money into that index fund and a little more money every year into those savings bonds. Next thing you know, you're living in Myrtle Beach, right? That's your retirement. That's nice. So there were a few other data points I wanted to show you. One of them is the Consumer Price Index. And I just want to talk a little bit. So CPIU is the Consumer Price Index Urban. So it's in the cities. So if you live in a small rural area, this isn't really going to capture it. This is city folk. You're up 6.5%. Non-seasonally adjusted over the past year. Now what's interesting is the seasonal adjustments take it down. You could see the seasonal adjustment is 0.4% month on month, lower, seasonally adjusted. So I guess they're screwing around with this. But so 6.5% inflation is pretty high inflation. So here's the problem. You put your money into stocks, you're going to earn 7.5%. Inflation 6.5%, you're earning 1%. You put your money in bonds, like we talked about, savings bonds, you earn 7%. It costs you 6.5% in inflation. You're making a 0.5% real return. But if you buy an 8-week bond, or I should say, as a treasury bill, or 12-week, or even half a year, you're actually losing 2% of your earnings power for the year. So either they bring inflation down, or you kind of have to take risk, or you just have to know that you're probably going to lose your spending power. The second thing I noticed was that there was a revision, and that they don't really talk about it. You go to the website and it just says, oh yeah, inflation's up 6.5%, driven largely by food, up 10.5%. And I eat all the time, so I really feel that inflation number. But it went up like yesterday, another 1.3%. Because of a revision. So they went back, they checked the numbers, and they found out, oops, we understated inflation. So last thing I want to do is I want to fly through some stocks, and I want to show you what risk off also looks like. So you can see the S&P 500 is down 0.25%. That's not a lot. That's like a rounding error, right? So your high beta stocks, though, if you look, the median loss is 3.5%. That's in a day. Remember we talked about capital appreciation of the whole market, 6% in a year. But if you go for the risky stocks, the high beta, the stocks with a systematic risk that's very high, you lost 3.5% on average today. 2 are up. Looks like about 18 of them are down. That's terrible. You look at negative beta stocks, and this gets interesting. Your negative beta stocks are primarily positive. Your VIX is positive. Your dollar is positive. So you really could have played the negative beta play today and done okay. Market's actually down. It's not happy, right? Now let's look at stocks that are down for the past year. They're down today. So what's interesting about that is if you think, oh, I'm going to buy the dip. Well, buying the dip didn't pay today. Buying the dip is a bad move today because they just keep falling lower. Stocks that are down for the year are down more today. How about stocks that are up for the year? These are stocks that are up 100% for the year or more. Mixed. Half up, half down. So you can't even say I'm going to buy the ones that are up. You're basically breaking even. If you buy the ones that are down, you're in trouble. If you buy the ones that are high risk, you're in trouble. I guess it's tough. The only thing maybe up? No. Quantum computing companies. Rigetti is up. But Arcit, which is a quantum security company, is down. Even your quantum computing stocks aren't necessarily up or down. They're kind of mixed. And so risk off means maybe stick with your low beta stocks. Low beta stocks are actually up more than they're down, right? Stay with the least risky. The most risky stocks, high beta stocks, are crashing lower. So stay low risk. And this is Jeffrey Cohen. I want to thank you for watching. I appreciate it. So if you like what you heard, come visit our website. It's chicagoquantum.com. We're in Highland Park, Illinois. We're taking clients. We meet in person. It's great, right? We'd love to work with you. We run these runs all the time, and we run them in different ways, and we charge different amounts of money for doing that. We also have meetings. We do financial plans. We do investment workshops. We do all that kind of stuff. And we also have a part of our business that focuses on quantum computing and quantum technologies. And so thanks again for watching. Good luck in the markets today. Again, as a reminder, it's risk off. So just be careful. Bye-bye now.